Awesome. Cool. Awesome. Well, the purpose of this, obviously, I'll tell you a little bit about me first. I've been in the lending business for 8 years, and recently, about a year ago, went out on my own, and I'm the co-founder and owner of Futures Funding, and we are hard money brokers. So while I was working direct for quite a while, when the climate changed a little bit and all the lending programs became more conservative and the credit boxes started tightening up, it just made sense that that was the right time to make this transition, so that we would have more than one credit box, more than one fund to lend from, which ultimately means we are saying yes more than we're saying no. So that is how we got started in this business. And over the past couple of years, with the way the real estate market has been going, there have been a lot of questions and concerns about DSCR programs. A lot of people are holding property more than they used to, and conventional loans aren't always the best way to go. So we decided to put on this webinar to kind of share some of the experiences that we've had, some best practices, and answer some pretty common questions that we run across when it comes to DSCR loans. So the first thing, I'm not going to have a presentation. I really just want this to be sort of me just kind of talking about the loan programs. If you have a question, you know, since it's a small group, just feel free to kind of blurt it out right now. If the group starts to grow, we'll worry about hand raising and things. But first of all, the DSCR loans, generally speaking, how they work and why they're different. As we know, if you're going a conventional loan route, there's a lot of things that come into play in the qualification and the underwriting. Most notably is your DTI and your income. When you're a full-time investor, especially, that can get really tough to qualify for, because if you are holding a lot of property and you're writing the depreciation off, a lot of times you're not really showing the income on paper that the bank would like you to have to qualify for certain loans and loan amounts. So DSCR loans became very popular because they don't report to the credit bureaus. They don't take into account your income, and they also are not based on any DTI. They're purely based on the value of the property, and most importantly, the incoming rent of the property and whether it covers the expenses. So DSCR, and I'm going to be pretty general here, but DSCR stands for debt service coverage ratio. And really all that means is that the incoming rents have to be enough to cover 1-to-1 at least your expenses, which would include your rent, or I'm sorry, your mortgage payment, your taxes, your insurance. Some lenders also wrap the property management expense in there, and HOA. So all those expenses have to be covered by your rent for the loan to work. The ratios will vary a little bit. A common number is 1.1, but we also see some lenders that require 1.0, some require 1.2. Those are questions that you'll always want to ask the lender, is what is your required ratio? Sometimes they'll have a minimum where they say, hey, our minimum required ratio is, let's say, 1.0. And 1.0 just means it has to be an exact wash. At the very least, your incoming rents have to cover exactly those expenses that we just discussed. If they cover them, if they ask for a 1.1, then that means they need to cover those costs and those expenses by 110%. 1.2 means 120%. So whatever their ratio is that they require is really just a reflection of how much they want the incoming rent to cover the cost by. So that's really how they work. It's a very simple calculation. I actually am going to show you here in a little bit a spreadsheet I put together, and I can make it available for you as well. That will kind of help you understand what you might qualify for in terms of loan amount based on all those parameters that I just gave you. And I'm going to show you how drastically the loan amounts can change based on a relatively small difference in the interest rate. Because as we know, interest rates over the past year have skyrocketed and gone crazy. So that's the bottom line, or at least the generality of a DSCR loan and how it works. LTVs on DSCR loans, again, a lot of these things vary from lender to lender, which is why we decided to get into the business of brokering, because every deal is different. And we wanted to have more than one option and more than one box to be able to provide solutions. So when it comes to LTVs, generally speaking, right now, you could expect 80% on a purchase. You could expect 70% on average right now on a cash out. There are some options at 75% for cash out. There was recently one option I was aware of at 80% for a cash out, but I do think that option is going away. As credit boxes have tightened and as the programs have gotten more conservative, we're really not seeing any 80% cash out, and 75% can be a stretch. A lot of that will depend on location. If the property is considered a little bit rural or a little bit of an outlier with the lender, they could potentially say, we'll do this deal, but we are going to give you a 5% reduction in the LTV. Not always, but that is one way they kind of feel better about protecting their investment. Also credit. This is where credit really comes in. The credit box will largely determine as well what type of leverage and LTVs you can expect. So if your credit is typically, let's say 720 to 740 and higher, you're going to be in one of the higher credit boxes. And again, these all vary based on lender. Right now, I'm not seeing many things get done under 640. So I'd say 640 is about the absolute basement in terms of required FICO score. And typically that is a hard pull, and that is a tri-merge. So they will take the mid score between the three major credit bureaus, and that's how they'll use to score you. 640 and lower is likely to get disqualified. But as you grow, increase that score from 640 up to, over 7, that is a lot of times what will qualify you for their, what we'll say is maximum leverage or maximum LTVs. So those things combined, experience is something you'll always get asked for, but we're not finding the experience to be as big of a factor in the loan program, in the LTVs. It can be a small factor in the rate, but generally speaking, isn't a major factor. Not like it is in fix and flip. So if you guys have done fix and flip loans, I'm sure you've been asked, how many of these have you completed in the past either 2 years or 3 years? And depending on that number, where you fit into their tier system or their tier level is largely going to determine how much leverage you'll get, what your rate is. Fix and flip loans are heavily weighted by experience. Here in the DSCR and the rental loan world, again, they do matter, they do count, but it's not nearly as impactful. So some lenders really don't care at all if this is your first. Others will give you a little bit of a break if you have, let's say, if you can show you have 2 or more. The experience may also come in when asking about property management. There are some lenders that will require you to use a third-party property management if you don't already currently own a rental property. So these are things you'll always want to kind of know, and some questions you might want to ask up front when you're inquiring about these loans, so that you're prepared to have the right answers and know if this is going to be a right loan product for you. So leases, very, very common question I get. Do I have to have a lease in place to qualify for this loan? And like a lot of these questions we're going to talk about today, it does vary. Again, when you purchase a property, you can use a DSCR loan to purchase property. In most cases, you are not going to have a renter in place when that happens. So typically, you will not be required to show a lease, to have a lease when you are purchasing a property with this type of loan product. That being the case, this loan product is overwhelmingly more prevalent in a refinance transaction. A lot of that has to do with the famous BRRRR strategy. So obviously, many people buying property and renovating the property and then adding value and doing a refinance and placing tenants. When that is the case, it's about 50-50 right now. I would say most are wanting to see a lease in place by the time closing happens. So that means if you are placing a tenant, if you're screening tenants, it doesn't mean you can't go ahead and start a refinance process, but it does mean that you probably should have a tenant most likely in mind that you are ready to sign or about to sign. Typically, what they're going to ask for, if they don't have a tenant currently already living there, is they will ask you for a copy of the signed and executed lease agreement. On top of that, they will often ask for proof that you have collected the security deposit and first month's rent. I think we all know the reason they do that is because anybody could sign a lease agreement. And it does happen where we have people come and they say, hey, we don't have a lease in place, but I can have my brother-in-law sign a lease so I can get this thing moving. And that's kind of how they get around that. You know, these underwriters and these lenders, they've seen it all. They're pretty savvy. They're pretty good at sniffing that kind of stuff out. So typically those are the requirements they'll be looking for, so they feel very comfortable, if you don't have a tenant in there yet, that you have a viable lease agreement started. So that kind of handles the lease agreements and how they work. When it comes to rents and qualification, another common question I get is, what if my lease agreement is higher than the market rent? And that happens a lot. And it happens a lot, especially if it's a BRRRR, because in a BRRRR strategy type of a transaction, generally speaking, you have rehabbed the property. It's probably a little nicer, if not a lot nicer, than a lot of the rental comps that we will be using to try to get what market value is. It'll be updated, it'll be fresh, it'll be new, and that typically would command and deserve a higher rent. So when that happens in today's market, in today's world right now, they are generally speaking still going to use market rents to qualify the property. And that can get a little frustrating, although you're typically not considerably higher than market rents, but you can be $100 or so higher. So generally speaking, they're still going to use market rents, and that market rent will be determined usually by a 1007 add-on to a standard appraisal. All of these properties, all of these lenders now are using full appraisals to value the property, and they will order a 1007 so that the appraiser will also give them some rental comps and his or her opinion of the market rents in that area. And the reason they do that is lenders are always kind of like insurance companies, and their whole goal is to mitigate risk when they're writing loans. And just because you were able to secure a rent that is higher than market rent, they like to fall back on, well, if worse came to worse and we had to take this property back, we can't be assured that we can secure higher than market rent. So that's how we're going to underwrite this. So generally speaking, that is what they will do. There are some lenders, although I think this is going to change, but there's one in particular that would use actual rents instead of market rents, provided they were within a 20% range. So as long as it was not more than about 20% of market rents, they would still feel comfortable underwriting the loan amount based on the actual rents. So so that's kind of how the leases work. It's kind of how they look at them to determine the loan amounts based on incoming rents. So far, any questions, anyone so far? Nope. All right.
I have a quick question.
Sure.
So you talked about the DSCR loans and like that you can refinance out of them. But I was curious because I'm still learning about these kinds of loans. What type of property would I buy? Like a property that's already ready to rent, or a property that might need some repairs and then be able to?
Understood. Great question. So generally speaking, the DSCR loan is meant for a property that is basically ready to rent. Doesn't necessarily, again, doesn't have to be rented. Usually if there's a small amount of work to be done, like let's say you owned a rental and you were going to turn it over to the new tenant. And when you turn it over to the new tenant, you're like, oh man, you know what? I got to replace some carpet in the bedroom, or I've got to do a fresh coat of paint, or, you know, the things, the type of work that you would typically do when you're just sort of doing a turnover, that is fine. If you're actually buying a property that really needs more than that, that actually needs rehab, then you typically are going to have to do that in a fix and flip or a bridge loan first, and then refinance into a DSCR loan. DSCR loans do not allow for rehab to be done. So if you have a full rehab, if you've got, a lot of times what they'll do is they'll put a cap on it. They'll say, hey, if you're telling me this property needs a little bit of work, we need to know what that work is and what it's going to cost. And they will typically have a limit that's, you know, somewhere around 5, maybe 10,000 at most. If you're like, hey, I need to do $10,000 worth of work before I place a tenant, but it's all literally like, maybe I need to replace a hot water heater, you know, stuff like that. If you, but if you're doing a full rehab, anything that's more than just a little bit of cosmetic turnover type stuff, you wouldn't be able to do that with a DSCR loan.
Okay, thank you for that.
Sure. Great question. Another question I get a lot is, how do we handle, or can we handle, short-term rentals, Airbnb, VRBO? Can we use this loan for that type of a purpose? Until recently, that's been very difficult. I wouldn't say it's a hard no. There are some companies and some lenders that have a specific short-term rental program. It varies a little bit on how they underwrite those loans. Some will require that you have already been operating for a certain amount of time and you can show revenue over the last 6 months, and they'll kind of take that revenue and they'll use it as the income to underwrite the loan and the loan amounts. We actually have one partner right now that will use AirDNA And what they'll do is they'll take their best shot at it. They'll get kind of the air DNA estimated revenue for that property. And then they'll take 10% off of that, sort of just as a risk mitigation. And they'll underwrite the loan based on about 90% of air DNA. When it comes to short-term rentals, they're always case by case. They're always a little bit tricky. They can get done, and I have financed those. But they're not quite as straightforward. They really do like to see some experience there, and they love it when it's already been operating at least for a little while and showing a little bit of proof of concept and some revenue that's coming in. So it is available. There are options for it. It's definitely something that if you're entertaining that, or if you're already in that space, and I would probably talk to your broker or your lender on the front end and just kind of start getting an idea of what that might look like. Because the last thing you want to do is, let's say buy a property with a hard money loan, like a fix and flip loan, get it all done, get it renovated, and then find out you're really going to struggle to refinance it, because that creates a lot of stress. So again, can be done, a little different conversation, and it's underwritten a little bit differently. So seasoning, probably one of the most common questions I get is about seasoning. If you don't know what seasoning is, that basically just, this is how long we want to see that you've held this property before we will refinance it. And especially if you've added value to the property, again, when we're talking the BRRRR strategy, which is super common, then you've bought a property for one amount, you've put certain amount of money into it, and then obviously the goal is to raise the value considerably on the back end. And when you raise the value, you want to get a loan in the LTV based on that new value, of course. So to protect against certain things, fraud being one of them, lenders today are mostly requiring on average about a 6-month seasoning period, which means if you refinance this property inside of 6 months of ownership, then we either A, don't even want to do the loan, or B, we're going to substantially reduce the loan amount. And what we'll probably do is say, hey, you bought it 3 months ago for X amount. We're using that amount for the value when we underwrite this loan and give you loan terms. So in that case, obviously that's going to be a pretty low number compared to the value to the LTV based on the new value now that you've renovated. So seasoning is a really important thing to keep in mind. 6 months is, again, pretty standard, pretty average right now. There are some ways around that. I have one partner that will allow you to, instead of being capped at purchase price, they'll say, hey, from 0 to 3 months, we will use your total cost as an indicator of value. And what that means is, if you buy the property, let's say for $100,000, and you put $25,000 into it, so you have a cost basis of $125,000, then they will say, okay, in the first 3 months, we will lend you a maximum of 80% of your cost. So 80% of your cost isn't bad if you're just trying to rate and term, not get cash out. A lot of times that can happen. From 3 to 6 months, they say we'll do 100% of your cost basis as a max. And then of course, from 6 months on, there is no cost basis. It's just purely based on the new value of the renovated property. So seasoning is definitely something to keep an eye on. It's something to keep in mind. It can be a little tricky, but most people don't have that big of a problem with it, especially if they're renovating the property. They're typically 2 to 3 months in already by the time they're finished and ready to place a tenant. It can take a couple of weeks to get that done. So 6 months is not a bad threshold. and it just kind of is what it is. So 6 month seasoning is what I would recommend you just plan your transaction around if you're looking to buy, renovate, and then refinance the property. So cash outs, you can do cash outs with this loan. Again, you're probably going to have it seasoned for 6 months to do that in most cases, because the leverage and the LTVs won't be high enough inside of that threshold to really allow you to pull any cash out. I will caution everyone that right now, if your plan or you have a plan to BRRRR a property, which if you're familiar with BRRRR, obviously the end goal is to pull your cash back out. And the idea is to take a certain amount of cash and to put it into a property, raise the value. When you're done, to refinance that and do cash out and pull as much of that initial cash investment back out so that you can repeat the process. A year ago, that was much easier to do. It's a lot harder to hit those numbers now. And as a matter of fact, we're seeing a lot of cases where I would say the most common phone call we've had over the past year is, hey, excuse me, I have a property or 2 properties or maybe 9 properties, but that I have purchased, and I'm a flipper. And due to market conditions, I can't sell the property now for what I wanted to make a profit. And so plan B is kind of always naturally, well, why don't I just place a tenant? I'll refinance it and I'll just hold on to it for a little while until market conditions say I can sell the property. So that's a super common phone call we've been getting over the past year, and it makes sense. However, at least 50% of the time right now, what we're finding is that even on a refinance, we are having to ask borrowers to bring money to the table because there's not enough equity in the property based on today's rates to do a cash out. So that's been a pretty tough scenario over the past year. I think this would be a good time to show you this calculator and what a drastic difference interest rates make on loan amounts. So all right. If anyone is not muted, can somebody just confirm you can see this?
Yes, we can see.
Okay, great. So this is a calculator I put together because I was getting this question a lot, which is, hey, I'd like to refinance this property. What should I expect in terms of a loan amount? Like, will I be able to pull cash out? Will I not be able to pull cash out? A lot of that obviously is going to depend on how much you owe on the property, but I wanted to show you this example. This is a pretty simple example of a rental property. I just kind of went through and just plugged in some pretty random numbers here. I've got 1,800 for the rent. I got 2,000 for annual property tax. That's probably a little high, but, and then we've got 1,100 for annual insurance. In this particular property, we're going to say there is no HOA and it's self-managed. So there's no property management fee. So really at this point, all we are doing is saying, okay, we have to, this $1,800 in rent needs to cover my monthly taxes, insurance, and loan payment, which down here is the loan payment. So what you'll see is the way I've got this set up is it's designed for you to put the information in yellow, and then based on whatever your lender's minimum requirement is for DSCR ratio, it's going to say, well, okay, for instance, if you have an $1,800 incoming rent and these are your taxes and insurance, and your interest rate is 6.5%, which honestly, nobody's really getting 6.5% right now. So, but I plugged that in on purpose. And the estimated current value of the property is $245,000, right? So if your lender simply is requiring let's say a 1.1 DSCR ratio, then the maximum monthly payment you can have to still meet this ratio is $1,378. And if you do the math backwards, $1,378 monthly payment on a 6.5% interest rate would be a maximum loan of $218,000. Well, that happens to be 88% in this case, which obviously would be no problem, because what's going to happen is with these DSCR loans, we talked a little bit ago about LTVs, and we said, hey, you're probably going to get a max of 80% on your purchase. You're probably going to get a max of 80% on a refinance if it's not a cash out, and probably a max of 70, maybe 75 if it's cash out. But what they're going to do is say, okay, well, that's the max LTV, but it still has to fit within our DSCR ratio. So what they're going to do is they're going to look at the maximum LTV, and they're also going to look at the maximum DSCR loan amount, and whichever is lower is which one you will qualify for. So if you see here, let's look at 1.2 as a example. At a 1.2 DSCR ratio, in this scenario, we could get almost 80% of our maximum loan amount. If I change this to just 7%, just a 0.5% more, I want you to look at this number right here, $196,445. A 0.5% just changed our loan amount by $10,000 to still qualify. So now we are at 186,000 at 76%. So not a huge difference in interest rate equals $10,000 in loan amount. Pretty big difference. If we were to look at this a year ago, I would say 5% would have been for decent credit, would have been a reasonable interest rate to expect. So at 5%, look at this, you could have qualified for, in theory, $231,000 just based on DSCR alone, right? Now I want you to look at today at 8%, which is closer to where we're at today. We just lost $60,000 in loan amount from earlier. So that's the impact that the rising rates have had on our industry. And if you figure we went from 5 to 5.5% to honestly 8.5%, that has been a very drastic difference in the amount of loan amount that you can qualify for on these DSCR ratios, which explains why it's been so hard to pull cash out over the last year, and sometimes even have to bring money to the table. Because if you're using a fix and flip loan over the past few years, the leverage on those has been 85, 90%. So if you're highly leveraged in your fix and flip loan, then it's much harder to refinance out of that now with these DSCR loans because of the way rates have gone up. So anyway, that's just a quick example. Does anyone have any questions about this calculation and what we just did there? I'm going to make this available for everyone if they think it would be helpful. All right. We will stop sharing. Any other questions at this point? We're almost done. Just a couple of quick topics to cover, and then we'll be kind of out of here. So, all good right now? Cool.
Yes, sir.
All right. All right. All right. Alternatives. So alternatives to DSCR loans, as we just talked about, it can be difficult right now to cash out. It can be difficult to even rate and term, just depending on how much leverage there is in the property. In addition to the rates going up, we're not seeing value going up a lot, right? In some cases, we are seeing some markets on appraisals come back as declining markets. We're seeing some values drop a little bit. I'm not seeing drastic drops in value, but we are seeing some values drop a little. At the very least, you know, for a while in most markets, like over the last 2 years, I would say, if we move back 2 years ago, in my experience, I have never seen as many markets across the country be as hot as they are. As a lender, we lend in almost every state, and almost every person I talked to, regardless of their market, was telling me how hot the market was. It wasn't just specific to Arizona and Seattle and Denver. Like for a while, it was very specific to markets. It was like Tennessee, hey, my market is going bananas. Texas, going crazy. It was unbelievable. So as values have obviously kind of stagnated, obviously when we go do appraisals and our values aren't quite what we need them to be, as well as the rise in interest rates, that's what creates that difficulty sometimes in cashing out on these loans. So the alternatives, a couple things. One of the things we've done recently is we've said, hey, these DSCR loans almost all have a prepayment penalty. That is usually either a 3 or a 5-year prepayment penalty. And those are called declining or step down prepayment penalties, if you are familiar with that term, which means in the first year, you're going to pay, if it's a 3-year prepayment penalty, in the first year, if you were to pay off that loan or sell the property, you're going to get charged 3% of the loan amount as a penalty. And then it just declines 1% from there. So a 3-year would be called a 3-2-1, and a 5-year would be a 5-4-3-2-1. Well, if you're in a loan that you really refinanced into specifically because you had a maturing loan that you had to get out of, but you, let's be honest, let's say don't love the loan product, maybe the interest rates are high, it's a little hard to cash flow now, but you had to make a move, a prepayment penalty isn't super attractive all the time in that situation. It can kind of make you feel like you're trapped in a loan that you don't love. So we are seeing some lenders offer some bridge loan refinances. We almost call them a Band-Aid loan, which is, hey, this is just another 12-month loan. It's going to give you a little bit of a break on an interest rate from like a normal hard money loan, and it's interest only. And so hopefully it still allows you to break even at the very least, and gives you a 12-month runway to kind of see what happens in the market, or not be trapped in a prepayment penalty. Let's say that you know, in 6 months, got a great offer, wanted to sell the property and just kind of get out from under it. Well, that is a Band-Aid loan that allows you 12 months of runway and flexibility to kind of decide what your next move is. If I get a great offer, I can sell the property. If something drastic happens with rates, maybe that's a good time to actually refinance into a longer term loan. Again, Band-Aid is what it's called. I think that makes sense to all of you. It's just what it is. Here's 12 extra months. Let's hopefully you can break even on it, not have to, probably not going to cash flow, but maybe not be a monthly liability, and give you 12 months to figure it out. That's one alternative that we are seeing. Another one is we have a loan product that is what we're calling a bank statement loan. And the bank statement loan, what it does is it eliminates the DSCR ratio as part of qualifying. So if you have a property here in Phoenix is a great example. The rents in Phoenix haven't gone up at quite the same clip that values have. So if you have a property that's kind of still high in value, but the rents aren't high enough, and especially at the interest rates we're at, to offer you much of a loan amount because of the DSCR ratio, then we have options in a bank statement loan. And it's really for self-employed people. It doesn't have to necessarily be a, doesn't necessarily have to be a full-time real estate investor, but you do have to be self-employed. I see Gerardo's here. Gerardo's actually gone through this process. And what we do is we take the last 12 months of bank statements, and the underwriters do some analytics on it to determine kind of what your monthly outgoing versus your monthly incoming is, and then kind of how much they could qualify you for in a loan amounts just based on your kind of your average daily balances. So it's an algorithm that I don't fully understand, and I don't necessarily need to, I guess, but it is an option that basically says you can afford this much a month based on 12 months of history of what you have coming in versus going out in your bank accounts. That makes us comfortable doing a loan for X amount. And when we do that, once we get an approval for that, if you have a loan or a property that needs to be refinanced, now I don't care what the incoming rent is. I don't even have to see a lease agreement. I don't care if there's a tenant. I'm literally just going to loan based off of the value. And we can get up to 80% on a rate and term refinance, and we can get up to 70% on a cash out, regardless of whether the rents are going to cover all that cost or not. So it's not a loan product that works in every market, because in some markets the rents versus the value are great, and it's not hard to qualify for loan amounts with that DSCR ratio. But in some markets it's very, very difficult, and that's a great alternative for kind of still hitting your objectives. So outside of those two alternatives, honestly, the only other one that I really can think of and that I know of is kind of back to conventional. Conventional's going to be based more on, again, kind of DTI. They will take the rent into account, but it's a different kind of a calculation. The rent that comes in through your rental properties is really more counted kind of into your income as opposed to a DSCR ratio. So that's really your alternatives to a DSCR product. And then document requirements. One of the benefits of a DSCR loan versus conventional is I don't need tax returns. I don't need pay stubs. Again, we're not going off of DTI. We're not going off of verified income. We're strictly underwriting the property based on the incoming rents versus the cost. So the document requirements would be pretty similar to a fix and flip loan, but you would be adding in the lease, and we would have to be adding some extra things to verify what annual taxes are, obviously making sure we have a good handle on the insurance. May ask for property management agreements. If you're using a property manager, that wouldn't be uncommon. If it's a condo, one thing I would really caution you about before getting into any condos is really having a good understanding of whether it is a warrantable or non-warrantable condominium. That can kill a deal really quick, and it's not always super easy to determine. So if you are looking for condos or anticipating or even thinking about condos, I would highly recommend that you talk to the probably the people in the office staff or the HOAs, and try to get as much information from them as possible about whether the complex is warrantable or not, because warrantable is a designation that would apply to the whole complex, not to just one unit. And non-warrantable condos have become increasingly difficult to finance. So if you are not familiar with what that means, let me know and I can give you a little bit more color on that. But it will be looked at pretty closely. So Outside of that, obviously the normal things, obviously there's an application usually involved, copy of your ID. In some states, you're required to take title in an LLC since these are investment purpose business loans only. Some states will let you take title in your own name. So, you know, let me know if you have questions about that specifically. There's charts that we all have at our, you know, that we can look at to kind of give you that answer. Lease agreements. A lot of times we'll be asking for a couple months of bank statements so that we can verify sort of what your liquidity position is. Even if you are doing a rate and term refinance or maybe even a cash out where you don't have to bring any money to the table on a refinance, it's still common to ask for the last 2 months bank statements. A lot of times a lender was going to want to see that you at least have enough liquidity to cover. It varies from 3 to 6 months worth of the loan payment, of the mortgage payment. They just want to see that you have that in liquid. Usually doesn't amount to a lot of money or a huge liquidity requirement, but that's a pretty standard ask as well. That's really it for the documents. It's not a heavy document loan. By the time we get the entity docs and bank statements, license, application, leases, we fulfilled a lot of those requirements already. So it's not usually a very difficult ask. Yeah, I think that is about it. That really kind of covers all the topics that we want to cover, and we still have a few minutes left. Anybody have any questions or specific examples or anything they want to run by us? Easy. Either I did a great job or everyone's asleep. I'm going to go with A.
Yeah, you definitely did a good job. You definitely answered all the questions that I had.
Perfect. Perfect. All my, if you haven't opened up the chat down there yet, my contact information is in there. I mean, we didn't have a huge turnout here. Hi, Prativa. I see you as well. I know that most of you already have my contact information. So, you know where to find me if you have any questions. I will send this calculator out to all of you via email, and you can just play around with it. I've got the cells locked that are calculations, so you can't mess it up. You can play with it as much as you want. If you have any questions based on what you're seeing there, then you know where to find me. So otherwise, everybody have a fantastic Friday. We will see you all soon. Gerardo, give me a call next week.
I got you, man. Have a good one.
All right. All right. Awesome.
Take care.
Have a great day, everyone. Bye-bye.